Hey everyone, welcome back to Bias Positive Digital Rise. Markets don't move randomly, they move in patterns, driven by behavior, structure, and narrative. If you've been following our BlockDAG series, you know I've been breaking it down step by step. Investigation 1 highlighted the widening gap between the promised pre-sale and the reality of after-sale batches. Investigation 2 explored repeated timeline delays and batch unlocks that kept shifting liquidity expectations. Investigation 3 traced the June tipping point when real supply pressure finally met a market structure that wasn't ready to absorb it. You can see from our previous content that I've been following BlockDAG closely, analyzing every update as it happened. Today, for Q1 2026, we're going to take a deep dive into how the market behaved, how tokenomics influenced outcomes, and what early investors experienced. Let's start with the pre-sale and after-sale dynamic. The pre-sale stretched over years, repeatedly announcing final hours that never seemed to end. Meanwhile, after-sale batches quietly kept releasing new tokens at extremely low prices, around $1 or even lower in some phases. Here's the critical part. Early pre-sale holders, those who funded the project from the very start, couldn't access the market. Deposits were blocked, wallets showed balances, but trading was suspended, and geographic restrictions prevented participation for the majority. Only a tiny fraction of holders could actually sell. Even with such limited access, the market price collapsed. Let that sink in. This wasn't market manipulation by sellers. This was a system that couldn't absorb even a fraction of its own supply, showing that the structure itself was fragile. And yet, the narrative pushed by the team and some defenders framed it as protecting the market or preventing greedy behavior. But here's the question every investor should ask. If selling restrictions were meant to prevent dumping, then why did the dump happen anyway, before most investors could even sell? And even if the price on CoinMarketCap appeared strong while access was restricted and prices varied wildly across exchanges, P2B at 44.4, Biconomy at 0.088, Pionex at 0.026, is that real demand or simply limited exposure? Because at the end of the day, a price isn't real if most holders can't sell at it. Now let's look at the tokenomics. BlockDAG has a total supply of 150 billion BDAG. The allocation looks standard on paper. 50% miners, 33.3% pre-sale, 12.7% community and ecosystem, 3% liquidity, 1% team. The team tokens were locked for 2 years. Pre-sale vesting was 40% at TGE and 20% per month over the next 3 months. And mining rewards are gradual. Sounds reasonable, right? But execution tells a very different story. Early investors are locked out while new supply floods the market at low prices. Liquidity is thin, not because the market isn't needed, but because the system and tokenomic design didn't allow a healthy free market to form. Compare this to Solana or other Layer 1 projects. The FDV to market cap ratio is balanced. Liquidity exists across exchanges, and early holders can freely participate. With BlockDAG, FDV is $36.29, market cap is 6.72, only 18.5% accounted for. A massive portion of supply is still locked, yet the price collapsed anyway. That's structural weakness. Community reactions reflect this clearly. Scroll through X, Reddit, or investor groups. Frustration is overwhelming. Empty dashboards, failed claims, suspended trading, no deposit messages. The vocal minority defending the team lean on moral framing. Don't be greedy, support the vision. Real investors hold. That's not analysis. That's narrative coping. Here's the important timeline. The team plans to open deposits and full trading on June 30th, 2026, with a so-called priority trading window on April 8th. Personally, I don't focus on labels like scam or legit. I focus on the market structure. If any liquidity window opens before June, like the April 8th priority trading, that's where the real structural test happens. My plan is simple. Calculate the risk, monitor the exchange's order book, and execute an exit as soon as the numbers hit my break-even or target levels. In high-risk structures, capital preservation is the only mandate that matters. Stay safe. Now, looking ahead to Q2, there's at least a glimmer of hope. For pre-sale investors who have held for years, enduring financial risk, time, and mental pressure, the June 30 deposit and trading window may finally allow an exit. My goal, and what I hope for the community, is at minimum a break-even point. EP. That's not ambition. That's survival after years of holding under extreme uncertainty. The uncomfortable truth is simple. BlockDAG's market existed, but the early holders who funded it were systematically prevented from accessing it, while new tokens were continuously sold at low prices. When even a small portion could finally sell, the price collapsed. That's a textbook example of an unhealthy market structure. Selling is not sabotage, it's the most basic right of any investor. If your system collapses under normal selling pressure, restricts access, continues new token sales, and then blames the buyers, the problem isn't investors. The problem is the system itself. This isn't FUD. This is what happens when a project raises hundreds of millions but fails to deliver open, fair market access. Investors didn't break BlockDAG. BlockDAG's own structure did. So, for anyone watching, take a moment. Look at the data, the tokenomics, and the exchange activity. Question every narrative that tries to shame you for wanting liquidity. And before we close, remember this. In trading and investing, the market is a mirror. If the system fails under normal pressure, don't blame yourself. Recognize the weakness. Stay disciplined. Keep your edge. If this kind of calm, data-driven breakdown helps you see the market more clearly, hit like, leave a comment with your observations, and subscribe to Bias Positive Digital Rise so you don't miss our next deep dive.